morning and welcome to our webinar with myself, Ilze Marie Le Roux. I'm joined by ETM Analytics Director George Glynos, as well as the Head of Risk Management at TreasuryONE, Wichard Cilliers. Gentlemen, thank you very much for joining me. And, you know, it's November. It feels like we've run half a marathon if you take from where we started. I mean, we at the beginning of the year, we were anticipating, 6 to 8 interest rate cuts. Biden was still vying for a position in the Oval Office. And I mean, the geopolitical landscape completely changed. In fact, the ANC was still completely in power beginning of the year. So it's been jam-packed to get to where we are, and we're not even at the end yet. But just looking at the last month or so, I mean, the happenings that's been going on, Trump has made his second position back into the office. We saw the SARB rate cut rates again yesterday. And I just wanted to bring in George here because there's obviously, with Trump, with the interest rate situation, there's also these underlying geopolitical currents, and it's starting to get really difficult to pinpoint where everything is heading to.
Yeah, morning, Ilze Marie and everybody. Good to be with you guys again. And I'm not quite sure what half marathon you're talking about, because I feel like I've run an ultra marathon and it's still continuing. But that's been the year, and it's been a busy one, and it's been full of exciting developments, interest rate decisions, elections all over the place, and obviously the latest one, the most important one so far, I think has been America, and obviously Trump coming into power. I don't know that anybody expected him to swing into power to the extent that he did, or to get the clean sweep that he did. But now that he has, it provides some really interesting scenarios that we've got to play through. And if you had a look at the Reserve Bank's comments yesterday at the MPC, you will have noticed, like, one of the comments that the governor made was that he wasn't comfortable giving any forward guidance whatsoever. And it's not easy to criticize him, to be quite honest, because there's just so much going on. So you just take this Trump coming back into power for another 4-year term as a case in point. And again, if you had to ask me, well, how do you play this? How do you play Trump? What is the Trump trade? What do we trade? What do we go long? What do we go short? What does it mean for the dollar? What does it mean for the rand? What does it mean for interest rates? It's actually a really difficult question to answer, because he is imposing himself in such powerful ways in so many different directions that it's almost impossible to tell what the full set of consequences are going to be, some of which might be unintended as well. So you're going to go down a particular road trying to reach an objective, and all of a sudden you get blowback in different ways. So, I've put together this chart just to go through some of what that is, and to give you a sense of how difficult it is to judge exactly what we're going to see play out. So the first is, geopolitics, obviously. And the geopolitics has taken a turn for the worse. You just have to look at what's happening in Israel, fighting Hezbollah. You look at Russia and Ukraine, and there in particular, the Biden administration ramped that up, allowing their missiles to be sent deep into Russian territory. The Brits have responded in kind and decided that they're going to do the same. Russia has now taken this as a sign of escalation and signed new treaties and not treaties. I've forgotten what they called it, but they're allowing themselves to make use of nuclear weapons as well. And just yesterday launched an intercontinental ballistic missile into Ukraine, which their defenses couldn't handle. So this has just ramped up to a whole new level, which is unbelievable when you consider that it's a lame duck president that's doing this in the final 2 months of his presidency, when the American people themselves went and voted against this kind of behavior because they voted Trump in, and Trump was looking to end wars. So on the one hand, you've got Trump sitting on the sidelines wanting to end these wars, which would be really good for risk appetite. But on the other hand, for the American economy in particular, you're removing a significant source of stimulus. So you get good on the one side for the rest of the world and for global financial markets, that risk appetite improves. On the flip side, you get a removal of some economic stimulus in the US. On other factors related to Trump, he's talking about bringing in tax breaks, great for economic growth, not so good for the fiscus. They're already running a budget deficit of in excess of 6.5%. There's an estimate that I've seen out there that if the tax breaks come through, that jumps to 8.5%. That's simply unsustainable. It's a crazy high number that's going to make their debt levels jump astronomically, and it's starting to feel a little bit uncomfortable on that front. So that's not particularly good. But countering that, you see that Trump also wants to slash the size of the U.S. government, and he's brought in the likes of Elon Musk and Vivek to run this Department of Government Efficiency. And if you've been watching anything that's been posted on X at the moment, especially by Elon Musk, he's been quoting all the libertarians. He's been quoting Milton Friedman. He's been quoting and posting a lot about Javier Milei in Argentina and the way that he went and slashed 3,000 regulations in the space of just 6 months. So it's almost like they are they're preparing us for the fact that there's going to be a huge amount of slashing of the size of government in the US. On the one side, really great news that they are going to reduce the burden on the tax base. On the other side, that's going to create huge dislocations and disruptions all over the place. So it's unknown what that effect's going to be. And then, of course, it's the whole question of tariffs. We know that he wants to use tariffs to try and rebalance trade. And on one hand, that's somewhat positive. On the flip side, it could spark inflationary pressures. So, again, you've got these pros and cons that are coming in, and it's quite difficult to know which one of these currents is going to be pushing harder and which one ultimately dominates. To end off with the mass deportation of illegal immigrants and regaining control of your border, well, any responsible government needs to do that. There's no question about it. That's a positive thing. On the flip side, though, America has relied on that immigration to keep its consumptive demand well elevated. And so there are question marks about, what effects that could have and whether or not the mass deportation not just detracts a little bit from consumptive growth, but imposes some form of inflationary pressures because you have less supply of labor. So, on all of these fronts, you've got pros and cons, and it's really difficult to know exactly which way to think about it. But there is a shift, and that's underway. And if we have a look at sort of the geopolitical risk, because that's the big one that I think is unfolding at the moment, it's really interesting to note that geopolitical risk at the stage of the game, despite the fact that it's escalated very significantly in Ukraine, has not spiked. It's not spiked like the beginning of the wars in either when Russia first invaded Ukraine or when Israel took on their war in Gaza. And that's pretty interesting because the only conclusion that I can draw from this is that people believe that because Trump is coming in, that they shouldn't necessarily overreact to what the Biden administration is doing now. Because ultimately, yes, Wichard.
Sorry, to jump in here, it's not right. And don't you think there's a lot of fatigue at the moment happening about wars? We are now our 1,002nd day of the Ukraine-Russia war. We've seen Putin coming out and saying he's open to ceasefire deals if Trump talks to him. So
yeah,
the Trump effect probably is taking place. But don't you think a lot of it is fatigue? People they hear about all these wars and what's happening in the Russia and UK, but nothing really escalates really. So don't you think there's a lot of fatigue in this war message as well?
Well, I would have said that up until this week. Because what's been happening with the missiles that are now being thrown across each other's borders, these missiles have taken it to a whole new level. I mean, what Putin did yesterday with that intercontinental ballistic missile, that's preparation for nuclear warheads. He launches one of those things, and I know it might be bluster and it might just be posturing and all of that, and no one really wants to go into a nuclear war, but we're closer now than we ever have been. And that's very much a function of what the Biden administration's done. So I think there is fatigue. Naturally, there is fatigue. It's been going on for too long now. And I'm hoping that we're not overly complacent because we believe Trump's coming in and Trump's going to try and resolve this very quickly. We've spoken about how Trump might come in and just overnight change the shape and scope of this entire war. Well, I can tell you one way that he could do that pretty quickly is just pull out of NATO.
Yeah, that would be interesting. Yeah, so
and make no mistake, he's threatened to do it before, and he's threatened to pull funding out of it as well. All of a sudden, NATO without America looks like a very, very different proposition, and suddenly the Europeans are going to have to man up for themselves, which I think changes the whole scope and the dynamic of the geopolitical situation. So, that's going on in the background, and I think it's worth just keeping an eye on. But, if we just roll forward to another couple of the charts, the one thing that I am a little bit pleased about is that despite all of this noise going on in the background and despite all of these scenarios, some good, some bad playing out, what we are starting to find in South Africa is that there are some signs of green shoots that are emerging. You can see that in this chart. Our short-term cyclical indicators is ticking up. It's almost back to break even and going into more buoyant territory. We actually think that that's going to happen through the course of 2025. And it's not just a rate cut thing. It's also about the government of national unity boosting business, consumer confidence. It's about inflation coming back down again. It's about households feeling a little bit more control of their finances, and it's about these reforms that the government is looking to implement. So, on that side, I think that's pretty positive. Of course, in the background to this, you've had the Reserve Bank that's gone and cut interest rates. So if you have a look at the next chart, it cut yesterday. It's off a high base. It's got a long way to go, but in this chart, the thing that should stand out to people is have a look at that blue line. That's your inflation rate, and it's dipped below the lower limit of the 3 to 6% target band.
Yeah, so
George, there was a lot of speculation and questions going around whether or not the SARB should have gone deeper with yesterday's rate cut. Now, we know they won't necessarily have taken already Wednesday's CPI figure into consideration, but with inflation seemingly, the forecast looking to go well below the band, are there arguments for possible deeper cuts to come in the next couple of decisions?
Ilze Marie, I think the answer to that is no, and I believe that the reasons for that come from the Reserve Bank itself. Kganyago yesterday was in one of the news sites this morning, MoneyWeb. They were talking about the inflation target review is nearing an end. In other words, they have been reviewing the inflation target. We know very well that the Reserve Bank, led by Kganyago, would like that target dropped, and I suspect that he wants it dropped towards 3%. What we're seeing at the moment is a golden opportunity for the Reserve Bank to do that. So I think they're going to remain extremely cautious and conservative in the way that they manage monetary policy, because they will want to try and gain a foothold in keeping inflation towards the lower end of this 3 to 6% inflation target band. So it's no longer just the case of mechanically thinking about these things as, we're below the inflation target band, therefore we've got full justification to cut. Well, that would be true under normal circumstances, but in current circumstances where we suspect that the Reserve Bank is wanting to push for a lower target, then I think it's more prudent to just hang off on that and just make sure that your inflation expectations as well as inflation remain subdued. Because if it does, the upside for South Africa over the longer term, and here I'm talking more like 2026, 2027, is that you effectively run with structurally lower interest rates because you have helped to structurally lower inflation.
And then from the Fed side, George, obviously we'll need to follow what happens from the Fed side. I think to show next slide again. But
Yeah.
They've been pulling the trigger and they've been cutting, and you still have this US exceptionalism. The job labor data was sort of starting to slow, but it's sort of stalled now again. Do you think the SARB also takes a lot of cues from what's happening from the Fed side, but they support the currency, is trying to support the currency as well, even with the blip that we saw now on our local currency?
Wichard, I think they definitely take into consideration what happens at the Fed. It is the benchmark rate that central banks all around the world use, and South Africa is no different. So, if the Fed's going to ease monetary policy, it does give the locals a bit of room to be able to do the same. I think, the point, though, is that, and if you have a look at this chart, and the point of this chart is to show you what one central bank is likely to do relative to the other. And as you follow the black and the blue line, the black being South Africa, blue being the Fed, you can see that the Fed is still anticipated to cut by a further 125 basis points. South Africa only by 50 to 75. So there is that conservatism has come through. Interestingly, if you have a look at the spread of bond yields, South Africa versus US, you'll see that they've compressed massively, and that's a very interesting development that I think we also need to keep track of, because it does eat into some of the carry attractiveness, South Africa's carry attractiveness. So now, you're talking about two very contrasting stories that are unfolding at the moment. Domestically, we've got a conservative central bank that's wanting to lower inflation. You've also got reforms that are coming in and people that are pricing out a lot of risk that they had priced into South Africa. In America, you've almost got the opposite situation. You've got a budget deficit that's ballooning and going wider and wider with tax breaks to come that might exacerbate that situation. You've got quantitative tightening, which is effectively selling the central bank selling bonds into the market. You've got China that is selling US treasuries into the market. On top of it, you've had the proliferation of crypto, which has pushed people towards alternative investment classes. And so all of a sudden, bond yields in America have steadily crept up and up and up and up. So there's an interesting dynamic here. The central bank is pushing in one direction. The market, the free market is pushing in the opposite direction, and it's compressing that carry trade that's unfolding in the background. But when you see a central bank that's likely to cut more than another central bank over time, that tends to readjust back into the markets. And so we think that Reserve Bank conservatism relative to the Fed is going to help at least stabilize the rand, make sure that it's not negatively speculated against, and holds at least some carry attractiveness. So, in terms of the Reserve Bank's cut, and to Ilze Marie's point, because I know there was some speculation that it could be 50 because inflation had dropped so far, I actually think that the Reserve Bank was spot on in their decision. I think their conservatism is warranted. I think it's the right way to go at this stage of the game, and over time, they will be proven to have been prudent.
George, sorry, you talked about reforms, and we started to get some questions. So we're going to tackle, like you spoke about reforms and how the government, the national unity is helping, and all of that. But everybody here in Gauteng, probably in Cape Town, where the two of you live, is a little bit less. But we've got a looming water crisis up here with Rand Water and struggling to have water, and a lot of municipalities running dry. How do you think any of that will affect the economy going forward? Now we've got the electricity crisis sort of sorted out, but I think water is the next one that's on its way. How will that affect our economy?
Yeah, and it's unfortunate that South Africa still seems to bounce from crisis to crisis. It's the only time we, as a country, tend to resolve things is when we have no choice but to fix. I think the reforms that I'm talking about, though, Wichard, are bigger than just a localized issue on water, for example. So let's talk about, for example, fixed investment as a percent of GDP. it has been one of the biggest concerns of mine for the longest time that South Africa simply hasn't been investing enough into infrastructure. In fact, the story of what's going on in Gauteng with water is the story of not investing enough in infrastructure. So the idea of government to try and take decisions that boost fixed investment as a percent of GDP, I think, is a fabulous one. And to invest into infrastructure, and that infrastructure is not just water reticulation; it will be part of it. It'll be roads, it will be Eskom, it will be ports, it will be railways, it will be the whole bang shoot. So your infrastructure at the end of the day is the lifeblood of any economy. If you don't have that plumbing, you can't push the water through. And that's the same, but in different ways for infrastructure throughout the economy. Now we're sitting with fixed investment as a percent of GDP, sitting under 15%. It needs to double. And this is the first time that we've had indications that the reforms are going to be significant enough to focus on that and to try and bolster that. So that's one of the reforms that they're talking about. The second part of the reforms is to focus quite squarely on the network industries and injecting the private sector into those network industries such that we get greater private sector participation, not just in running, but investing in some of these infrastructural projects, which again, not just helps grow the foundational tax base, but obviously helps to improve the efficiencies throughout the economy. So for all of these reasons, these are the kind of reforms that we're talking about. So yes, we can get depressed about Eskom and Transnet and water reticulation. But generally speaking, the base has been depleted, but the focus from here on out on policy seems to be in line with boosting that investment into the economy.
Thanks for that, George. And then I'm going to go to your next slide, because your next slide and the next question sort of goes hand in hand about inflation. Is how is the real CPI debate, i.e., it simply reflects that the rate of change year over year is declining. However, over a sustained period of the COVID years, prices across all supply chains escalated at an exorbitant level. So price levels worldwide is at exploitative levels. So now we're only seeing a slowdown, but not a declining index. Do we see more inflation? How do we tackle it longer term? What is the view on inflation?
Yeah, so look, inflation is a constant drain. The only way that an economy adjusts over time is through things like wages that eventually rise back up to mitigate some of the effects of that inflation. People, finding better paying jobs, etc. There's adjustments that take place through an economy slowly but surely in the phase that follows the inflation shock that people need to make ends meet at the end of the day, and they somehow do ultimately. So I don't know that inflation ever is not going to go negative anytime soon. But so long as it slows, it gives people the opportunity to be able to catch back up to where they were, and to try and get some sort of stability in their cost of living, etc. So that obviously is assisted by things like interest rates coming down, for example, also help at the margin. But in looking at inflation, the monetary variables that we're looking at right now are telling us that inflation is likely to remain reasonably contained for the foreseeable future. That's good news. And by our risk index right now, we see that the easy gains on dropping inflation are now past. That black line is not likely to experience as powerful disinflationary pressures as we've seen in the recent months. But we still got an inflation environment that's going to remain a little more comfortable than we've had for in recent years, and so through the course of 2025, 2026, you'll see that manifest in slightly better economic growth data and slightly improved consumption figures. All of that to say that lower inflation also helps to ensure that the rand enjoys a greater amount of resilience. So it's in everybody's interest to try and keep inflation as low as possible. The Reserve Bank's conservatism, therefore, is warranted, we believe. And we think that for the time being, inflation is under control. So no dramatic issues there that we need to contend with, which means that we will have a more stable interest rate environment going forward, potentially rolling onto a slightly more stable rand environment as well.
By the way, if anyone has further questions, please make sure to post them on the comment section. But George, just a question that is not on one of your slides, so maybe it's a bit of left hand, but China, we've seen, has been struggling to reach their growth targets. And you and myself have had a couple of discussions around what's happening in China. But we know the Chinese government has embarked on massive stimulus measures. We know they're in the middle of a trade war with the EU. More tariffs expected to come when Trump, enters the Oval Office. There are expectations that the youth unemployment rate might skyrocket. Their property industry is still in the lull, still struggling to recover from the last couple of years. How concerned are you about the possible impact of this slowing Chinese economy? And I know China is still, just because they're slow, it doesn't mean it's small. It's still very big, but it is slowing. And being South Africa's biggest trading partner, what could the impact possibly be going forward?
Yeah, so I mean, there is an impact, but let's just keep some perspective here. China is still growing. It's not like they're going through a massive recession. Right now, their growth rate is still positive. That economy is still growing. And whilst it might feel like a recession in China because they've gotten used to growth rates far higher than they've got at the moment, and things running a little more smoothly than they are right now, it's still a very dynamic economy, and it's an economy that I think if you had to bet against them, you'd probably lose more times than not. I've learned that lesson the hard way. So, insofar as China is concerned, naturally we've got to pay attention to the slowdown. The slowdown has effects on a range of different issues. One of them being their prices and inflation or deflation. Interestingly, their monetary cycle at the moment is so soft that we could, in fact, be talking about deflation in China for some of the reasons that you've mentioned, but also just because their credit cycle is as tight as it is. The point to make is that they're still the world's biggest exporter, and so they're going to be exporting that deflation to the rest of the world, which means that there is a lowering or a disinflation imperative that they are imposing on the world. Insofar as South Africa is concerned, it would be nicer to have China growing a little more rapidly because it is South Africa's biggest trading partner. But China on its own doesn't make up all of South Africa's GDP. And there's a lot that South Africa can do domestically to help itself. It doesn't need to constantly rely on other economies' growth rates just to remain supported. It can do much of the heavy lifting itself. And I think we're kind of at the cusp of that. We're seeing some early signs that this National Treasury and this Department of Finance actually gets it. We think that they understand it better than most of their predecessors, and that the economic policies that are now being adopted are more constructive than we've seen for a while. So, South Africa has a lot to do. And yes, we can focus on China and we can focus on the effects of all of that. But really, South Africa can do quite a lot to help itself. And I think they will. The indications that we're seeing at the moment is that we are entering a new policy phase, which we haven't seen before, which is more constructive. It's more upbeat. I'm not trying to downplay the mess that the ports are in, or that the railways are in, that logistics are in, that the state of our roads and water etiquette. I understand and I know all of that. But if you're asking me about the prospects for the next couple of years, there are signs that we are going to be recovering off that very low base. And at the very least, we can feel a little less concerned that we are going to be moving in the right direction, as opposed to what we've had over the past decade, which has just been a steady degradation and deindustrialization. So it's kind of a more upbeat assessment, although you need the context that it's off a low base. And I think that's the story of South Africa at the moment.
I think the ratings agencies also agree with you, because we've seen we've been upgraded from stable to positive, and although Fitch came out and said they don't think our debt levels after the medium budget speech that was announced will top out where it tops out, will top out a little bit higher, they expect, but at least they're also making the positive sounds on the rating agency side that we sort of reached the bottom of our downward spiral. So that they do agree with us on that.
Yeah, look, we've got a lot of work to do, Wichard. It's not like you tweak a couple of policies and we're off to the races again. There's a lot that needs to be implemented, and the problem is we've had the better part of 15 years of degradation. That's the problem. 15 years is not easily reversed in a year or two or three. Ramaphosa can start the process through his second tenure, but it's going to need continuity after that. So the way you get a good economy is by making repeated, prudent decisions over time. It doesn't happen overnight. A lot of these things take a very long time to, and it's always, the saying goes, it's always far more difficult to build something than it is to break it down. We've broken down a lot in this place, so now it's time to rebuild, but that's going to take time, and you're talking generational stuff. But at least if you're moving in the right direction, you need to cheer that and encourage it, and hope that there's more to come.
No, there's definitely, the right noises being made. We're seeing the state making inroads in meeting those targets to get us off the grey list, which I think is very important, and hopefully that could happen in the next couple of years. And then, it's these small pockets that we're seeing. If we watch what happened at Home Affairs, for example, with backlogs being cleared. So there's really these small pockets of excellence, but for now it's small pockets, and we need more, but hopefully that will gain traction as we move forward into 2024. But gentlemen, I think that's it, unless anyone else still had questions or anything that they want to say. Oh, good.
We need to chat about the caveat in the room, because everybody's here to happen about our currency. We've been the best performing currency up until a point. We've had a little bit of a blip. The Trump trade that you mentioned, it came in, and the rand went from lost a magnificent 5% or R1 in the space of a week. So if you look at our world currency ranking, we spoke about it on Monday, Ilze Marie, that the rand went from the best performing currency for the year, which we still are, top of the list. But in the space since Trump being elected up until now, we right at the bottom is one of the worst performing currencies, George. What do we expect from a local currency perspective?
Yeah, so there was a little bit of unwind that maybe we got a little bit ahead of ourselves with the hype around the GNU and all the positivity that came through that. So in a sense, the Trump trade, is it really about the Trump trade, or is it about the fact that we had maybe just overcooked how much positivity we needed to price into the rand in such a short space of time? I think, to be quite honest with you, as I look at this chart, it looks a lot more realistic now than it did. And even though we are still the best performing currency on the year, I think it needed a little bit of rationality to come back into it, and that's where we find ourselves. So, that black line pulled back very, very sharply, and you can see that it pulled back a lot more than other countries, barring maybe Russia, but Russia's in the middle of a war. So, maybe not the best example to compare ourselves to. So compared to other currencies out there, rand did perform particularly badly when Trump came into power. But there were other elements to that. It was about AGOA. It was about South Africa aligning itself with BRICS, and what Trump felt about the African continent more broadly speaking, and whether or not that would have an effect on South Africa's geopolitical standing with regards to Russia as well as Israel. As it turns out, Netanyahu's there's an arrest warrant being issued against Netanyahu, and that's largely as a result of South Africa's efforts. And now, at least that's one factor that is going to be mitigated, because, well, the world has pronounced on what they think of Israel, and South Africa seems to be on the right side of that. whether you agree with it or not, that's the way the world has interpreted it. But there's still some question marks over South Africa's relationship with the US, trade relations, etc. So we did correct a little bit more than most, but then again we were so far ahead of everybody else that I think a little bit of a correction was a healthy thing. And so I'm not too perturbed about it. We seem to have stabilized now, and the dust is going to settle between now and when Trump takes over, and then we'll be able to see what he's really going to implement. And on the back of that, you'll get a stronger, more pronounced response. And then if I go to the last chart that we had on the rand's valuation, what it's really done, I mean, we got ourselves back towards fair value, which was that dark orange line in the middle. We got ourselves to fair value. We traded around it for a little while. It was, it was comforting to know that the rand had it in it to be able to do that. We've now retreated slightly, and so there's a little bit more value there for exporters to take advantage of. I think they should. I don't believe that necessarily that we've seen the end of all the rand's strength. So exporters can take advantage of this. Maybe they'll have even better levels when Trump comes in and starts moving things around. But for the time being, I'd say that these are better levels than you had a little bit earlier this year. That they're more favorable for exporters. If you are an exporter, I would say at least utilize this opportunity as something to lock in more attractive rates, and let's see how things go. Interesting also, because inflation has softened to the extent that it has, that the fair value forecasts, expectations for the rand are now looking a lot more benign than they did. Whereas we were talking about heading closer to $19 to the dollar, we're now still sitting at 17.5, going all the way through to the back end of 2025. So that is a change that's happened over time, Wichard, and I think it's important to note that our fair value assessment has now softened and become a little more stable, and again speaks to the importance of being able to keep inflation in South Africa low, and it lending some support to the real effective exchange rate.
So, George, we've been talking about 17 to 18 being the sort of range for the rand to trade in for the next 6 to 9 months. Struggling over my words, I can't believe it. Does that range still hold value? Obviously, breaking out like we've seen just now above the 18, creating opportunities both sides, probably breaking out, but more sort of stable next 6 to 9 months in the 17 to 18 type of range?
Yeah, I think given the initial market response to Trump and the way that we've reset, and the fact that there's some realism that seems to be creeping back into that market, you might want to raise that to maybe a 17.30, 18.30 type of range. So you raise it a little bit, but I wouldn't go too much more than that. At this stage of the game, I think the rand still has a healthy amount of resilience in it. I still think there's enough positivity in South Africa to be able to hold a range. And the fact that we're trading more towards the upper end of that range right now, again, I suspect is a signal to exporters, for example, to maybe utilize the opportunity that currently exists.
And then lastly, what I've taken out from all of this is geopolitical risk, Trump coming into office, uncertainty in China, uncertainty about data. It all just sets up for volatility, especially if you look at valuations in the US equity markets. That's still up there, up in the air. Is it sustainable there? So all of these scenarios that we're talking about seems to me like there can be a lot of volatility. So people need to brace for volatility, manage the risks in their business, make sure that they protect it, and really set up to make sure that they hedge themselves and position themselves towards the volatility that we can possibly see. There is a lot of uncertainty that's going to happen in the markets. But we always say volatility creates opportunity. So When there's opportunities, I think we must make use of the opportunities and look at it and use the volatility in our favor. Is that a fair summary?
I think it is, Wichard, and I think the key comment there is that risk management. So that risk management, I think, is absolutely critical. And you're quite right. That volatility does create opportunities on both sides, for both sides of the trading equation. So yes, I would say that is the way to go. And the other thing that I might just add into that is that because of the uncertainty, don't be too greedy, because just as quickly as it moves one way, it can move back the other, for seemingly insignificant reasons. But for the most part, I would say use the opportunity as it exists and leverage off your risk management processes that you have in place.
Yeah, Ilze, if you've got any closing comments for us.
No, I just wanted to mention, George mentioned it, with Trump coming into office, we've had a lot of questions, and you see the discussions happening on the possibility of AGOA being suspended, our trade agreement with the US. And I think it's just, no one knows exactly what Trump is going to do. The man's a big talker, but, how much of what he says he's going to implement is something that we're going to have to wait and see. So we cannot say that, AGOA is completely out of danger. But I think it will be wise to keep in mind that Trump uses, and we've seen this with his first term, that he uses tariffs and other restrictive trade policies with countries as a way to strong arm them into something that he wants, or to bring them in alignment. He's not just going to come out and swing the axe and go haywire. That's not exactly how he operates. So, again, I just want to say that we don't know whether AGOA is really in danger, but to not overreact. We're not that high up on his priority list right now until there is something that he wants us to pull in alignment with, or if there's something that South Africa can, he needs us to give him something for something. So it's just important to not overreact, I think, about Trump's campaign rallies and campaign claims that he made. But other than that, I think from our discussion, and taken from 2024, hold on to your bootstraps, because I think we're in for a ride in 2025, and it's going to definitely be an interesting one. And who knows what the discussion is going to look like this time next year.
Thank you. Thanks, everybody.
Yeah.
Enjoy the weekend, and we'll chat soon.
Thanks, everyone.
Thanks, guys.